Welcome to the August 27, 2018 Advance Report for McGowan Group clients and NetWorthRadio.com listeners. I'm Spencer McGowan, your financial weatherman for your weekly fast-paced tour of the global financial markets. Today, a longer view, but first we're going to answer a question. Is it bad news that consumer credit reached record levels? A total of $13 trillion, total liabilities of U.S. household $15.6 trillion, according to the last report from McGowan Asset Management. Is that too much debt? The answer is it's just a smidgen above 2007. Let's look at the real picture, just in case the headlines lead you to be too pessimistic. Overall net worth for U.S. households, net worth after all liabilities, was just below $68 trillion at the peak of 07. You can see the dramatic fall here of about $10 trillion. Then we look at what's happened since then. $102 trillion overall record net worth for U.S. households. That is an absolutely huge increase. In fact, more than 50% in net worth, while total liabilities have stayed relatively stable. The consumer's ability to withstand their total debt is actually the best it's been, even better than 1980, when the cost of debt service was just 11%, just below 11. Now we're approaching 10.3%. And homes make up a huge part of that, pension funds, other assets. If you're worried about the $21 trillion in overall debt, put it in context here. The pension funds, over $20 trillion. Other financial assets, $40 trillion. That's over $60 trillion, which would love to own U.S. Treasuries at some yield. In fact, the United States is more self-sufficient than ever. Here we're looking at 20-year long-term returns, and then I'm going to give you the real story for investors. We look at the S&P 500 over the 20-year period, including 2 bear markets. Important education here. If you reinvested your dividends, you got about a 7% annualized return. Total return 284%. If you were in the bond index, the Vanguard bond index, then your return was 4.6%, including the 2 bear market cycles. How did the average investor do over that 20-year period? It cost me over $1,000 to find out from Dalbar, because they do the study taking all the mutual funds, looking at who exited, who entered, the timing of investors. The 20-year return, not 7, not 5, 2.5% was the average investor experience in equity and fixed income mutual funds over the same period. It begs the case for coming down to the Crescent. Get your plan from the team that cares, McGowanGroup Asset Management. Go to NetWorthRadio.com, fill out the preliminary client questionnaire. Now we take a look at the emerging markets. Average equity return, 9.3%. With huge downside volatility. The emerging markets carry value at risk of loss over 50%, even the bonds. We use a measure of the bond index, one of the managers that's been active since 1992, an 11.78%. This is reinvested, but if you reinvested in emerging market bonds, ironically, you did better than equity. So, there's 2 lessons there for emerging market investors. This is a 15-year. We include a 10.25% return for the 15-year period. That does include the bear market cycle, which you can see right there. 20-year U.S. Treasury, if you reinvested, you got 6%. We go to the emerging market equity over that same 15 years, about 11%, and our emerging market bond proxy did about 10% during that period. So that's a 15-year view. And keep in mind, over the 20-year and the 10-year, the average return for mutual fund investors was just 2.5% due to bad timing. And another 15-year recap just for educational purposes on the asset class returns. We've got emerging market equity 13 over this period according to the measure from McGowan Asset Management. Small stocks 11%, REITs 11%, large stocks 10%. High yield bonds actually competitive with equity with less volatility, 9.6%, and the average asset allocation during that period, 8.3%. So you can say we really do need a good plan going forward for asset allocation, and we've got one here at McGowanGroup Asset Management. Be sure to come down to the Crescent, meet the team that cares, upgrade your plan. Be sure to subscribe to the YouTube channel for McGowan Group, because when there's fast-breaking markets and crisis, you'll want to get a special update, which we'll do right here. I'm Spencer McGowan, your financial weatherman. Today, it is our pleasure to bring you the long view of the markets and investor education that empowers your future decision-making. My firm, McGowanGroup Asset Management, sponsors NetWorthRadio.com and, of course, our YouTube channel under McGowan Group. Some educational disclosures and discussions that I wanted to add to the broadcast. The first is, I'm very proud of our team, including Stephen Norris, who will be added as soon as we redo the picture. He's our newest team member. Come down, meet the team that cares, get a written plan, because the securities we discuss, the financial news we discuss, that's not a recommendation until you actually come down and get a customized plan at the Crescent. You'll get a tour, and we look forward to seeing you. We're going to cover value at risk of loss in portfolios, and you can see it right here. Learn about our performance, what happened in 2008, how long did it take to recover. All of those items are posted right here at NetWorthRadio.com or the McGowanGroup.com. The other part of the program, when we look at price fluctuations in bear markets and risk control, that's a huge part of NetWorthRadio.com. We look forward to helping you advance your plan and your cash flow. Come down and meet the team that cares.